Hello, everyone, and welcome to Jason FinTips. I'm Jason Ball, and I'm glad you're here. Before we begin, please note this video is for educational and informational purposes only. It's not financial, investment, legal, tax, or insurance advice, and no professional recommendations are being made. I do hold a CFP, ChFC, and CLU designations, but I'm not acting as a financial advisor, fiduciary, or legal representative during this session. Any examples I share are just hypothetical illustrations of financial concepts. If you need help with your own situation, I strongly encourage you to talk with a licensed professional. You can always find my full legal disclaimers at jasonfintips.com/legal. Now, let's dive into today's topic. Just take a quick look. I wanted to talk about tax efficient investment strategies. I think this is something a lot of people end up running into. Everyone's okay, what is actual tax efficient investment strategies? And I just kind of wanted to break it down to just get a basic understanding. Um, and the nuances of tax efficient investing is akin to mastering kind of sailing, I think is a good analogy, because there's going to be things where it's going to depend on not just one situation, but there's factors that might go together. But the concept of tax efficiency is pretty straightforward. It's simply you're just trying to find where do I put these accounts to minimize, or how do I strategize to minimize my overall tax liability based on my individual situation. And that involves income state, business ownership, non-business ownership, a W-2, where's the income coming for, and how much tax am I going to have to pay on that? So tax efficiency is measured by how much investment returns are actually eaten away by a tax. And that could be for a bond that's on a taxable portfolio. Taxes on an individual bond could be ordinary income taxes, whereas you could have a stock that has qualified dividends that's held for a long enough period, might be at a lower tax rate. These do change through congressional acts when they redo the tax bills. So there's actually opportunities to strategize for taxes for yourself and different marginal tax rates where a lot of the planning takes place at. But kind of getting some building blocks is there's different ways to manage your individual tax rate on this. Different investment are taxed in different ways. Interest on bonds, for instance, is typically taxed in ordinary income tax rates and can be as high as 37% for some taxpayers. In contrast, qualified dividends and long-term capital gains can benefit from lower tax rates, capped at 20%. Some investors are nearing the 0% capital gains tax rate. So, what are the building blocks of a tax efficient portfolio? The first thing we want to look at is understanding tax advantage versus tax advantage versus taxable accounts, so asset location. The concept of asset location is pretty much fundamental to tax efficient investing. It involves strategically placing investments with different types of accounts based on their tax treatment. Tax advantage accounts, such as a traditional IRA or 401k, offer tax deferred growth, meaning you won't pay taxes on dividend, interest, or capital gains until you withdraw the funds and you have to pay tax it. You have constructive receipt of the income. Typically, in retirement, on the other hand, Roth IRAs and Roth 401ks provide tax-free growth, but money contributions are made with after-tax dollars, and qualified withdrawals are tax-free. This creates some planning opportunities. Tax advantage investment vehicles. Certain investments are inherently more tax efficient. Municipal bonds offer exempt from federal income taxes and in some cases state and local. You also have deferred tax accounts, which plays a huge role in many people's long-term planning. This is your traditional 401k, your 401k at work, your traditional IRA. Contributions are deducted pre-tax and put into the account, and the accounts are deferred until the money is withdrawn. At that point, you pay taxes on them. So that's the tax deferral. Tax-free accounts, maximizing retirement income, are powerful tools for tax-free income in retirement, although contributions to these accounts do not provide immediate tax deductions. The tax-free growth and withdrawals can be substantial for long-term investors. These accounts are particularly advantaged for individuals anticipating to be in higher tax brackets in retirement or those seeking tax diversification. So let's kind of take an idea here, get a little quick here. So a traditional IRA does pre-tax, a tax treatment with withdrawals or taxes ordinary income. Contributions, you can change on yearly, they are going to change. And there's probably income restrictions, and then there's going to be required minimum distributions to pull the money out. versus something like a Roth. It's going to have post-tax money that you're going to make deposits that you put into the account, but you're going to have tax-free for qualifying withdrawals. Income restrictions, yes, there's going to be income caps on some of the who can make contributions to those. Kind of just gives an overall, but the main thing is you've got them. You can either be taxed on the front end or the back end inside a traditional IRA, and inside those they are taxed as the traditional IRAs. You get a deduction based on your ordinary income tax rate versus a Roth. You pay your taxes. And then invest in a Roth, and you're going to pay taxes on the growth when it's pulled out. So, and a couple of things we got here for the different types of investments that can be used. We have index funds or ETFs, are kind of like the cornerstone of tax efficiencies. This way you can be low cost, low tax, and use something like a diversified portfolio. There's other individuals who build portfolios that look like tax loss harvesting. And what they're trying to do is take and maximize the amount of taxes that they can get, take the losses from assets and be able to offset those against gains in each year, and slowly be able to, quote, harvest the losses inside the taxes. And it can be a powerful tool to reduce your overall tax liability. Some tax efficient investing types are municipal bonds, are very tax efficient. They also have lower expected growth rates. Interest is often exempt from federal and state taxes. Stocks, they can be very tax efficient. They can be tax inefficient depending how you buy and sell them. They put inside an individual stock inside a taxable inside of a Roth account. You've also got stocks that are held for longer than a year, a long-term hold. Those typically can go inside a tax-deferred type account, and they're going to be subject to short-term. They're going to be subject to long-term capital gains tax if you can have them over a year, and short-term capital gains taxes if you're held below a year. So you've got two different rates there. So there really is, am I going to have this as a short-term investment or a long-term investment, can significantly affect the return or taxes paid on those investments. Holding periods, leveraging time for tax appearancy. Let's just say you could do an ordinary, taking a look here at a holding period that you hold an asset, a stock, for example, for under 1 year, you could be taxed at 37%. And if you were to hold it over 1 year, you could be taxed at 20%, just inside the different capital gains tax rates. So you might have an ordinary income tax being applied to a short-term gain, but you might be able to hold that for a long-term gain to go down to zero at some tax brackets. So, advantage of tax efficient strategies, we've got some asset placement, matching investments with the right, so matching the investments with the right accounts. There's other strategies, charitable contributions, or leveraging appreciated securities to be able to do charitable gifting or charitable gifting remainder annuities. There's also direct indexing as a custom approach to tax management, involves owning individual securities that compromise an index rather than owning the index. The cost to do this actually has to be bigger portfolios. So for a lot of investors, this may not actually be a very financially strategic way. It may not make sense. It may not be financially feasible for some people to do this. We've got a couple here for examples. Some common pitfalls. We can look at these really quick. Imagine an investor, Alex, who has a mix of taxable and tax-deferred traditional and IRA Roth accounts. Alex strategically might place high-growth stocks in a Roth IRA to take advantage of the tax-free withdrawals in retirement. Bonds, another portion of his portfolio, which generate regular interest, might be held in more of a traditional portion of his IRA portfolio, and he's deferring the taxes until withdrawn. Meanwhile, the tax-efficient index funds are kept in a taxable account, minimizing taxable gains distribution. We've also got to thankful for some tax loss harvesting. Let's say John, who's a diversified portfolio and a taxable account. During a market downturn, several of John's holdings are at a loss. Instead of holding on all these, Jordan sells some of the real losses and realizes those for tax purposes against some of the gains. He may reinvest the proceeds into similar but not substantially identical securities to maintain the portfolio's allocation. Holding periods and capital gains. Samantha, an investor who is in high tax brackets, purchases shares of a fast-growing company. After 11 months, the shares have appreciated significantly, and Samantha is tempted to sell and take her profits. However, by waiting just 1 month to exceed the 1-year holding period, she qualifies for long-term capital gains tax treatment, and she can significantly reduce her tax liability. This kind of highlights the importance of mindfully understanding the holding period of your assets and how you can use some patience and tax strategy to possibly lower your applicable taxes. One of the things a lot of people learned a few years ago was overlooking the impact of mutual fund distributions. A lot of people who had diversified portfolios were all of a sudden at the end of the year hit with large tax bills because the portfolio manager had remanaged or rebalanced the portfolios and taking some large gains and distributed the distributions um, to the mutual fund to the owners of the fund, and they ended up having a lot larger distribution than what they had planned for during those years, which led to a larger tax bill. Neglecting wash sale rules and tax loss harvesting was one thing that I think has caught a lot of people off guard, and that is something where if you purchase a substantially identical security within 30 days before the sale, violating this rule can lead to the unprecedented tax bill. Essentially, you go to tax loss harvest, but they disallow the deduction for the loss because it was done within a 30-day period. So you don't get to do the tax loss harvesting. This can make sure to be careful when you're doing this and ensure the securities that purchased around the same time of selling a loss harvest do not generate a substantially identical fund per asset that can deny your basis on the wash sale rule. Failing to consider state and local taxes. Much of the focus on the tax efficiencies is focused on the federal and state. Also, federal level, state and local taxes can also have an impact. Some states have high income taxes in certain investments, like municipal bonds. Other states may be taxable at the state level. The ignoring importance of diversification for tax purposes. For the purpose of tax efficiency, there also becomes a risk of overly concentrating in certain assets or accounts. For instance, if a heavily favoring a Roth account for their tax-free withdrawals might leave an investor exposed to legislative changes affecting Roth IRAs. A balanced approach, diversifying about different asset types, tax-free, and taxable, might give an investment vehicle compared to tax efficiency and protection against long-term legislative changes and uncertain markets. So, navigate the intricate world as tax-efficient investing is imperative. Be vigilant about what you're doing. Tax codes can and will change. Markets will change. Nothing is for certain. That's why you may make sure to consult with a tax professional, someone that has software, a professional advisor, someone that can advise you and guidance for your individual situations. But always make sure to understand tax efficient investing is a crucial component of long-term planning, especially when you get into things for like planning for retirement income, for marginal retirement incomes. Say, what is my retirement income going to look like, and how do I manage that tax bill in retirement? One strategy might work very well for one individual, another strategy might work for another individual. It could depend on your state, income, assets, inheritance, pensions, Social Security. So and what you believe may happen to taxes in the future. So hopefully that gives you a little bit of an idea. Love to hear your feedback in the comments. Thank you very much.